Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking about an exceptionally topical issue. We're talking about global monetary policy and the massive secular changes that are afoot and probably will be going on for at least a few more months. We're speaking today with Rohit Goel, who is a CFA. He is partner of Breakout Capital. His team is responsible for the country selection, allocation, and hedging frameworks for the global sovereign wealth and pension funds. Previously, he was with the IMF. He's a member of the Economic Club of New York, the Bretton Woods Committee, and he is a non-resident fellow at the National Council of Applied Economic Research in India. He earned his undergraduate degree in IIT Delhi and an MBA from India Institute of Management, Bangalore. In addition to his CFA, he is a Kaya charter holder and holds an FRM certification. So, Rohit, thank you for being here on the podcast with us.
Thank you so much for having me on the podcast. Before we start, just wanted to mention these are my personal views and not attributable to Breakout Capital or any of the other associations.
So let me just ask you a very broad question to start off. Is how do you see monetary policy right now? We've had a massive amount of change, through the beginning of May here in this year alone. So how do you see monetary policy pressures now?
I mean, more broadly, I would say there is a big disconnect globally, specifically talking about the US. I don't think monetary policy has been very tight. That's partly because how the balance sheets have evolved over the last 10 years. And also we can also see that there is a change in how you would look at R-star. And we can see that in the equity markets and the economy as well.
So when you say the balance sheet, you're referring, I presume, to the U.S.'s federal debt.
I'm talking also about the corporate and household balance sheets.
Okay.
A ton of corporates, they really took long-term loans,
right?
Which you can see they did not feel the need to reprice when the rates went up, which is why when the rates went up, we did not see much of an impact on ground. And which is why I feel that contrary to some of the commentary that we hear, I don't think monetary policy has been very restrictive or very tight so far.
Interesting. I mean, this is exceptionally interesting because obviously they haven't refinanced yet, but perhaps for some of the lower rated bond issuers in the high yield market, that space might be facing it sooner than later.
No, absolutely. And I do believe that from that perspective, US is in a bit of a bind because Fed can't really cut rates very aggressively. Inflation is still sticky.
Right.
Rates have not been restrictive enough. On the other hand, the long end of the yield has a lot of pressure, and which is what we are sort of seeing in the high yield market and the other issuances.
Yeah, the yield of the long end of the bond is exceptionally interesting. We've talked about it on so many podcasts that we've recorded in the last couple of weeks because it was just eye-popping a couple of times. And then you also mentioned a little bit about the consumer in the U.S. What are you seeing there? Because I think that, we did see a bump last year in subprime credit card defaults, but it bumped and stopped.
Right. No, and that's the much infamous K-shaped point, right? If you look at the U.S. economy, consumer has been the one which has been leading to the exceptional growth in a way.
Right.
But even within that, there is a big disconnect, right? The top end of the consumer, their balance sheets, their household finances have been in top-notch shape.
Right.
And the bottom end has been seeing the pressure, which is what we see in all the credit card delinquencies. Now, going ahead, we do see some pressure on that front.
Yeah. I mean, I left out. I should have said there was also a bump in subprime auto defaults in the fall.
Absolutely.
So, yeah, but those are a little bit hard because they came up from a very low level.
That's correct.
Right. So, but not in the right direction, but came up from an exceptionally low level. Well,
which is what you're also seeing on the unemployment rate, right? So at the margin, things are ticking up. But are we really at the point where Fed needs to act and really behave decisively? Not really, right? The market is still very tight. There are these pressures building up, but it's not that broad-based.
Yeah, and this brings an obvious question about when will this pressure come to roost? This is the hardest part about investment management, right? Everyone knows something's going to happen, but when?
And that's always the tricky part, right? It's always impossible rather to time these things, but we know for a fact that pressures will continue to build up. Even the top end consumer, which had been holding the consumption and the economy at bay, it will incrementally start feeling the pressure because of wealth effect, because at some point of time rates will need to be repriced. So you would see that in their own balance sheets as well. So that's sort of the broader view that we would see economy weakening. Not obviously tariffs have some role to play. Even outside of that, going forward, economy would weaken. At some point of time, Fed will need to act. But at this point, it's probably too soon.
Right. Interesting. So there's sort of a divergence across many markets right now. Could you talk about your view sort of broadening beyond the U.S.?
Sure. I think, and even pre-tariffs, like, I mean, we are an emerging market investor, so there's a lot of disconnect even within emerging markets. But specifically, if you look at most of the banks, they had increased the rates quite decisively in the pandemic.
Yep.
What they did, they kept the rates at a high level.
Yep.
Despite the fact that there were growth pressures, partially because they did not want their FX to depreciate.
Right.
Now in this new regime where we do see pressures building on dollar and we might see portfolio allocating to international markets, we would see that the central banks in emerging markets or international markets in general, they'll have a lot more flexibility to cut their rates.
Right.
And that's what we are also seeing in many central banks doing now, whether it's in LATAM or Asia, that now they have the financial stability policy space to cut rates and drive the growth.
Right. Well, so the pressures on, let's just separate that out a little bit, because the pressures on Latin America are a lot different than Southeast Asia. So the perhaps we could just focus on Latin America for a second. The presumably a weakening dollar, as we've seen it weaken in the last couple of weeks, is sort of net good for them, right? So could you talk a little bit about how you view monetary policy specifically within the group of countries in Latin America beyond that?
Right. I mean, and that's sort of the challenge and the beauty of emerging markets too, right? Even within Latin America, you would find countries across the spectrum, right? So Chile was able to cut rates over the last 1.5 years.
Right.
Peru did a surprise rate cut yesterday because now they think they have the space to do that.
Right.
Brazil, I would argue, is the outlier. Its real rates are 10 to 12%, which is historical high. And so far, it's been not very open to cutting rates. In fact, it has been hiking because of financial stability issues. Now we see that Brazil is one country where it can surprise quite positively because FX is on their side. Dollar has been sort of depreciating. Real rates are already very high at a time when other markets have the capacity to cut rates and they're cutting rates. Brazil, you would see, can surprise, even if not cutting rates immediately, at least in terms of forward guidance, that we are end of the hiking cycle. Now for the next 8 to 12 months, you would see rate cuts coming in.
Okay, and do you think, where do you place, when you said an outlier, I thought you were going to say Argentina. So where do you think they are? Because they are sometimes the canary in the coal mine.
No, I mean, and I used to work at the IMF, so Argentina is very close to heart.
Right, you know a lot about it.
that respect. But the way we look at Argentina has always been more on the structural side. So for most other markets, it's been a cyclical growth and inflation story. For Argentina, it's a structural recovery from the position they were in. So the way we look at Argentina is that, look, they were in a tough bind. They had 120 years of waves of defaults and waves of crisis. Now we have a leader who is taking the tough measures to bail the economy out of the tough spot they were in. Right. Which is why, despite inflation being relatively high in absolute terms, they have the confidence that they can cut rates to drive the growth. So the way we look at Argentina, it was in a very tough bind. Now it is past the hump. And growth is like 5 to 6%, which is phenomenal. Yeah,
it's and I always like to say whenever we talk about Argentina, I love visiting Argentina. Great food. It's a wonderful place to be. It's a hard place to work, but it's a wonderful place to be. So don't forget, by the way, all to you CFA New York people, they have great pizza there. I said it. Well, I guess it's also kind of interesting. Let's shift gears a little bit and go to Southeast Asia now. How are you reading the divergence there?
Sure. No, so within Southeast Asia, the two parts. One is the cyclical and one is the structural. In cyclical, it's the same story that they had kept the real rates very high because they were burned during the Asian financial crisis. So they did not want to end up in the same position. Now they have the policy space to start cutting rates. So over the next 12 to 18 months, you would see that they would cut rates, both because growth is weak and dollar and portfolio flows are supportive. More broadly is because of all the supply chain realignment and the tariff discussion, there is a big question about the economic model of these economies in itself. And you would see incrementally the export-led model, which was always the thing that drove these nations, that's somehow under challenge, or at least, they have to reach a new steady state. In this ecosystem, you would see that domestic policies and rates would need to come to the forefront to drive the growth.
Yeah, this is one of the areas where I think it's exceptionally difficult to forecast anything, right? Because of that uncertainty. The chair of HSBC has been talking a lot about globalization shifting to regionalization, which is always a possibility for Southeast Asia. Absolutely. Because it has some fairly rich cultures right around it and some consumptive ones as well. So that makes that particularly difficult to anticipate.
And particularly, I would say exciting too, because and not just in Asia, in the sense, if you look at global trade, there is a lot of argument that, oh, globalization is over to an extent. But if you look at the data since 2016 end, when Trump sort of first came to power, US is the only major nation where trade to GDP came down.
Right.
For 80 to 90% of other markets, developed or emerging, their trade to GDP has increased. So they are trading just increasingly with each other. So Europe is doing intra-Europe, Asia is increasingly doing intra-Asia. So that, I think, is a good diversifier for their own economic models as well.
Yeah, it is exceptionally interesting to see how there's this kind of misconception about where growth comes from. I also think the end of globalization is kind of funny because I'm sort of a big fan of the historical records of the Silk Roads, which, as far as I can tell, tells us that globalization started about 1600 years before the birth of Christ. So somewhere around there.
Oh, absolutely. So you can bet on it sustaining for a bit.
Yeah, so I'm not too worried about the long run. Could we talk about Europe now? Because that's we sort of left it out. And it's, Europe is dogged by a few things. They've had a massive amount of policy uncertainty, relatively slow growth, and relatively high prices for some time now. So how do you see that space?
No, I think the biggest question about Europe always has been that, look, structurally it has been in a tough position and productivity growth continues to be slow. When will they get the act together and drive the growth, right? So one of the changes we can see is obviously what happened in Germany, and now they're sort of finally deciding to spend more. They still have a lot more to do. I do believe that money is not just the only issue with Europe. They have to get their regulations in check. They have to get their monetary policy cycle in check. So there needs to be a much more broad-based coordination. But the way I look at Europe in the next 5 to 10 years is, thanks to Trump tariffs and thanks to the realignment, maybe international is becoming great again. That Europe finally has a reason that, look, we need to get our act together and focus more on currency reunion, capital markets reunion. So now they're finally into action. Let's spend more. Let's try to be more productive. Let's try to be less dependent on everybody else. It's just a strategy which takes time.
Yeah, I mean, the political changes in Germany were eye-popping, right? Germany, really? But I guess one of the problems they have, and I think you made a reference to this, is that the EU changes very slowly, and that is the seat of the regulations. Is that what those EU regulations? What you're talking about?
Yeah, that is generally has been to reach consensus in Europe is a very slow-moving, painstaking job, which is part of the reason why the productivity growth has been so slow.
Right.
The regulations and the role of state has been so excessive. One argument which we always talk about, whether it's emerging markets or nations in general, you want to be more productive, you need to decrease the role of state and increase private sector, right? The productivity differential is pretty high.
Right.
Europe needs to go down that path rather than using this as an excuse to increase the role of state and effectively just going down the same path all over again.
Europe is also a very diverse place economically. People often leave out that they talk about France and Germany an awful lot, not about Romania, for instance. Let's zoom in on Europe for a second. How do you see the diversification of those markets and their flexibility with monetary policy?
No, I mean, again, it's pretty varied in general, but we do see that many of the peripheral European markets, which historically were sort of written off, that's all France and Germany, as you rightly mentioned, right? They have got their balance sheets and stuff in check, right? So Greece used to be under immense pressure. Now that
massive change
issue is beyond us, right?
Yeah.
So from that perspective, we do see that many of the non-core European markets, whether it is Poland, Greece, Romania, Spain, Portugal too, to a decent extent, they have the policy space to drive the growth. They're coming from such a low base that they can actually bring forward the reforms and do more collaboration. The issue with monetary policy is it's still a consistent thing to some extent. You can't just completely deviate from what the other nations are doing.
Right.
So that sort of always is an issue in Europe. But more broadly, we do see that many of the other markets, especially on the emerging market side, they do have the capacity to drive growth, both through monetary policy and fiscal.
Yeah, I mean, it is exceptionally interesting because while European growth has slowed, it's stable. And the issue with the prices could be addressed to some degree by monetary policy. Like that is because that's the thing that's been dogging a lot of them.
Absolutely.
Yeah.
So it's always a trade-off, right? In the sense the growth and the inflation trade-off is pervasive, right? For all central banks in general. The question is that when your currency issues are not that much of a concern, then for a central bank is easy to focus on the growth angle rather than the inflation angle, because they can cut rates without worrying that the FX will completely go out of whack. So from that perspective, I see a common thread in international markets, whether it's Europe, emerging markets, UK, that the external pressure they had on their currency in a regime where dollar was always very strong, that for the next few years will, in our view, be let up.
Okay.
And if that goes away, then they at least have a lot more flexibility to do the kind of actions they want to take.
Well, interesting. So let's talk a little bit about what a weaker dollar means around the world, because it has varying different impacts. You all take the view that the dollar will be weaker over the next couple of years. So how do you handle your analysis of companies, et cetera, in different regions around the world?
Sure. No, I mean, look, the two parts, right? So the view on weaker dollar is almost purely because of cyclical factors. There's a lot of commentary which goes around American exceptionalism and dollar reserve currency. In my view, that is sort of almost uncorrelated to what we will see now, which is dollar was overextended, cycles turn, now dollar will weaken. That's part of how economies evolve.
Right.
And that will have repercussions in two ways. One is through the economic channel, which we have been discussing, that if dollar weakens, that gives international markets some flexibility to cut rates without worrying about their currencies depreciating very fast. That's one. The second channel which happens is a lot of the capital over the last 10 to 15 years flew into US, right?
Right.
So those portfolio flows, if we go into a regime where dollar would weaken for the next 2 years, 4 years, everybody has a different assessment, then you would see some portfolio reallocation out of US into international markets.
Right.
That again gives many of these international markets, specifically emerging markets, the financing they need to drive their own growth.
Right.
So that's one way in which economies will benefit. International markets will benefit through dollar depreciation in general. Now, the point that you made, obviously the difference is a lot, right? Whether you're looking at domestic companies versus exporters.
Right.
So investing is a constraint, multi-factor optimization in that perspective. But more broadly, from a global asset allocation perspective, that gives both policymakers and companies a lot more flexibility.
Okay. Well, so the other thing that helps a lot of foreign companies is the U.S. consumer. So in a scenario where the dollar is weaker, the U.S. consumer might buy less from foreign companies. How do you figure that into your, as we just said, multi-factor analysis? Is that something you all look at, or do you think that gap will just be taken up by regional partners, so as it is maybe already?
To some extent, they will be. But again, US is still a very big market, right? So as you rightly said, it's not possible to just replace US. To that extent, if you take a sectoral view, you would want to be more focused on consumers rather than just exporters, right? So when we look at emerging markets overall, and you look at the Asian tigers in the past, the story always has been that emerging markets become rich by exporting to prosperity. Right. But a lot of emerging markets, they have very big consumption bases, right? You talk about Brazil, India, Philippines, you can go down the pecking order. So from an investment perspective, that focus will incrementally shift away from potentially exporters towards the domestic companies.
Yeah. This is exceptionally interesting to me. And it's also been a long time coming. You just mentioned the Asian tigers, which were super exciting and made people lots and lots of money during a few years. But the one that really emerged the most was probably South Korea, right? And the other ones took much, much longer to get to there. And probably one of the better stories from there is Vietnam.
Absolutely.
Right. So going forward, do you expect it to be something like that, where there's, if there's growth in these areas, do you think it's going to be spread out more, or is it going to be the old fickle investments that go to the one that looks like it has the best shot?
No, I think the two factors, right? One is at the end of it, look, we are in a flux right now. Everybody's trying to figure out what will be the steady state when it comes to reshoring, nearshoring, friendshoring.
Right.
But the truth of the matter is that all of these emerging markets are still extremely cheap.
Right.
Versus manufacturing in US or Europe, right? So if you want to imagine a world 3 years out when things sort of stabilize, let's say, it's very difficult to imagine that companies will decide to shift 100% of the manufacturing into US and move out of Vietnam or Bangladesh or Cambodia, right?
Right.
If MNCs, they'll rather cut their margins and take the tariff impact rather than moving the production. So in a steady state, I do think that most of these markets, they had a distinct advantage of being cheaper of having the resources to drive the manufacturing, which other countries don't want to do. So those things are still there. The margins have reduced a little bit.
I'm so glad you said that, because one of the things that gets left out of the onshoring, reshoring discussion is that those networks have physical capacity, or they have physical things. You can't just change them one day. You can't just, there's this concept that you can just send the ship to a different port.
Exactly.
It doesn't really work like that.
No.
Right? And it takes 10 years and it's expensive. So,
Which is that when you, like, we talk to a lot of companies and policymakers, and the markets react aggressively. But when you talk to these guys, they are much more calm. That, look, we knew this was coming to an extent. We have been trying to diversify outside US or to strengthen our supply chains the way we can, but we have a moat or a structural advantage which is difficult to beat.
Right.
Now, I think the one nuance which you brought earlier is relevant. For instance, South Korea, right? Part of the reason South Korea became South Korea at such a fast pace is because they did an exceptional job of moving up the value-added chain.
Right.
So countries like Sri Lanka, Bangladesh, which manufacture rubber, apparel, relatively less differentiated products,
Right.
they might feel that they are at a bit of a challenge.
Right.
Countries who have been able to create a moat around their exports,
Right.
that's very difficult to dilute.
Yeah, I mean, if you look at South Korea's approach to fashion, makeup, all that stuff, that's hard to beat. I mean, they are ensconced in that.
I have a 5-year-old son. He listens to K-pop.
Oh, yeah, my son does too. Yeah, my 15-year-old son, when he was a little bit younger, he didn't watch traditional sports. He watched professional video game players. His favorite team was the South Korean team.
Talk about soft power, right?
Yeah, it's remarkable. So anyway, well, thank you, Rohit, for being here. This has been an exceptionally interesting walkthrough around the world twice. So thank you very much.
Thank you so much for having me, Rob. I've been a big fan of this podcast, and I'm very happy to be here.
And thanks to everyone who listened into this podcast. We touched a little bit on the high yield market. CFA New York does have an event coming up in June on the high yield market. It is exceptionally interesting one-day look at the U.S. market. But boy, is this a good time to look at it, because the high yield market has been frozen solid. So we will need some experienced people to look at it and tell us what they think. So please sign up for that event. Until next time, I'm Rob Rowan, and this has been Compound Insights.